Robinhood just moved 12.3% in a single session, and most people covering it will tell you the same surface-level story without asking the harder question. A 12% move on a stock with a multi-billion-dollar float is not noise. That is a deliberate repricing by institutional capital, and it happened for reasons that are specific, traceable, and instructive. So before you chase this or dismiss it, the real question is this: does the catalyst behind today's move actually change Robinhood's long-term earnings power? Or are you looking at a one-day event that institutional desks will quietly fade by Thursday? Let's start with the mechanics of why Hood moved, because the catalyst matters more than the percentage. Robinhood's business model has three primary revenue engines in 2026: payment for order flow on options and equities, net interest revenue from margin lending and uninvested cash, and transaction-based revenue from crypto. When any one of those levers accelerates materially, or when guidance implies it's about to, institutions reprice the stock fast and without apology. The trigger for today's session appears tied to a combination of a stronger than expected revenue print, with net interest revenue showing particular resilience in a rate environment that many analysts assumed would compress Robinhood's spread income. That assumption was wrong, and when analyst models are wrong in a visible way, the stock moves to correct the gap between consensus and reality. Here is the specific thing most retail traders miss. Robinhood's funded accounts crossed a threshold that changes how Wall Street models the platform. User count is a vanity metric. Funded accounts with real assets under custody is a monetization signal. Each marginal funded account contributes to margin lending capacity, options premium flow, and the float of uninvested cash that Robinhood earns interest on. When that number inflects upward with deposit growth attached, the revenue compounding is nonlinear. The actionable insight here is discipline before entry. A 12% move on genuine, fundamental re-rating is structurally different from a 12% move on a short squeeze or a viral retail moment. Your first job before touching the order button is to identify which one you are looking at. In this case, the data suggests this is not pure speculation, but that does not mean the price is right today. Now here is where we have to be honest in a way that most finance content refuses to be. A move being explained is not the same as a move being justified. Those are two different analytical questions, and conflating them is how retail investors get caught holding a bag that institutions handed them at the top of an intraday spike. To evaluate justification, you need to anchor on a multiple. Robinhood trades as a growth fintech, which means the market is pricing in future earnings expansion, not just the current period. In 2026, the relevant comparison set includes companies like Coinbase and Interactive Brokers, both of which trade at well-defined revenue multiples that the market uses to triangulate where Hood should sit. Here is the tension. Robinhood's revenue is still heavily correlated with market volatility and retail participation cycles. When markets are calm and retail disengages, order flow revenue compresses. When crypto goes quiet, transaction revenue drops. This is not a stable, recurring SaaS revenue model. It is a cyclical, activity-dependent business dressed in fintech clothing. That distinction matters enormously when you are trying to assign a forward multiple. What today's move implies is that the market is giving Robinhood credit for diversifying away from its most volatile revenue sources. The retirement account push and the expansion of margin and cash management products are structural bets on stickier revenue. If the deposit retention data supports that narrative, meaning users are not just opening accounts but actually keeping assets there, then the re-rating has fundamental backing. If deposit churn is high and the funded account growth is driven by promotional incentives that expire, the thesis is much weaker. That is the variable you need to track over the next 2 to 3 quarters. Not financial advice. This is how you build a thesis before capital is at risk. If you are earlier in your investing journey, this event is a masterclass compressed into a single trading session, and the lesson has nothing to do with whether you should buy Hood tomorrow morning. Lesson 1. Volume confirms conviction. Hood moved 12.3% on heavy volume. That phrase, heavy volume, is not decorative. When a large price move happens on low volume, it is fragile. Thin order books can produce dramatic price swings that reverse quickly because there's no institutional weight behind the move. Heavy volume means real capital changed hands. Funds repositioned, that is structurally more durable than a retail-driven spike, though not guaranteed to hold. Lesson 2. You are almost never first. By the time a stock is trending on financial media and you are reading about a 12% move, sophisticated participants have already acted. The question for you is not whether to chase the momentum. Chasing a gap up on emotional FOMO is one of the most reliable ways to destroy capital. The question is whether the underlying thesis, now that it has been revealed, changes your longer-term view on the business. Lesson 3. Single-day moves reveal hidden positioning. A 12% gap implies that before the catalyst, a large number of participants were either short the stock or significantly underweight relative to benchmarks. When they are forced to cover or add, the move is amplified beyond what the fundamental news alone would justify. Understanding this short interest and institutional positioning dynamic is how you interpret magnitude, not just direction. The meta skill here is learning to ask 4 questions on any big move. What was the catalyst? Is it durable? What does the valuation imply now? And who was caught on the wrong side? Master those 4 questions across dozens of live events, and you will develop pattern recognition that no single trade can teach you. That is the compound return on paying attention to markets as an active student rather than a passive observer. We opened by asking whether today's 12.3% move in Hood was a genuine repricing or just noise that smart money will fade. The answer, based on the data, is that this looks like a legitimate partial re-rating, but the next 2 quarters of deposit retention will either confirm or destroy that thesis entirely. The follow-up question we're going to answer in the next video: what does Robinhood's long-term competitive position actually look like against the traditional brokers and the crypto-native platforms trying to eat its lunch simultaneously? Subscribe so you don't miss that breakdown.